to the housing update for August 2024. My good friend and cohort, Cheryl Stokes.
Hey, everybody.
And Mary Bartos from Premier Plus. Let's get right to it, Cheryl. Let's talk about what's in the news, which is mortgage rates. So What the heck is going on?
Well, we're hoping, like everybody has been, that they're on the decline. They actually have been on the decline. But the Fed decision says, in support of its goals, the committee decided to maintain the target range for the federal funds rate in July. But we've got September coming up.
Yeah. And that's incredible from a standpoint. What is, our chief economist at Moody's Analytics saying?
So he said basically the same thing. The Federal Reserve stuck to script, holding monetary policy unchanged, but strongly suggesting a rate cut is likely in September. That's what we feel as well. Mm-hmm. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. Global investors are cheered by this. Stocks are up a lot. Bond yields are down, as they should be, and the economy is set to soft land.
Love the soft landing because we've been kind of limping along with these crazy mortgage rates, which really takes affordability out for a lot of people.
It does.
Right?
It does.
I know we have a couple more people weighing in here, but what is Sam Qatar saying at Freddie Mac?
Well, he says mortgage rates declined to their lowest level since early February, which I would agree with. Expectations of a Fed rate cut coupled with signs of cooling inflation bode well for the market, but apprehension in consumer confidence may prevent an immediate uptick as affordability challenges remain top of mind. And they do. Despite this, a recent moderation in home price growth and increases in inventory are a welcome sign for home buyers.
Yeah, because what happened in COVID was everybody had to do it like crazy now.
Yes.
And Cheryl, the stat is like 78%. I don't know if you're one of them that bought in COVID are dissatisfied and want to move.
Well, and it makes sense because so many people felt the pressure to move now, move regardless of the high bids, et cetera.
Right.
And now they're looking back on it going, maybe that wasn't a good choice.
Maybe I didn't like that choice. So this is all great news. We have one more quote, and all of this is now to talk about what's happening with unemployment. And they go kind of hand in glove, right?
They do. They do. And so the unemployment I can't speak today. The unemployment rate rose by 2 percentage points to 4.3% in July, and the number of unemployed people increased by 352,000 to 7.2 million. These measures are higher than a year earlier when the jobless rate was 3.5%, and the number of unemployed people was 5.9 million.
Okay, so we're 1.5 million, roughly, 1.3 million difference. But Cheryl, when you look at unemployment rates over 30-year period, like crazy, what's happening with that?
Right, we're below the average. We're at 4.3, and if you look at this graph, the unemployment has increased, but not to an extent that it seems to be problematic.
Right.
It's actually, we're in a really good spot. And it's like everything else. You see those headlines, but you have to really see the numbers to know that it's really within the realm of reason.
You honestly said something that we haven't said in a long time. Headlines are meant to terrify and not clarify.
Correct.
And honestly, that's what's happening with folks, for whatever reason. Last month, we talked about politics and elections and what happens in those election years with, they go hand in glove with what's going on.
They do.
But it's interesting that the good news is unemployment went up a little tick and rates come down. So therefore, better for the economy.
Better for the economy.
Yeah. And so Lawrence Yun, the chief economist of NAR, what's he saying? I know you hate this word. So
I do. So Lawrence says mortgage rates are plunging on the news of weak job growth and rising unemployment, but plunging is a very big word. Did they decline? Yes.
Yeah.
But we have to remember that rates are volatile and they move a little every day. Yeah. And we had 3 days of decline. And then the following Monday, what did they do? They went back up a little bit. So
for the love of God,
they are trending. Exactly. So they are trending, not plunging.
I love it. So Lawrence, we're going to correct your word and say trending. And if you look at this 14-week, is that really from April of 2024 to this week? 14 weeks.
Like 16, but yeah.
16. Okay. I can't count. So 16 weeks, it's the lowest that it's been.
Right. And so it is trending downward.
Yeah.
But see all those little ups and downs, ups and downs, ups and downs. So you can't read a headline like this, go a week later and say, what's my rate today, and expect it to be what you saw a week ago.
Right. They need to contact you, really, honestly, for sure. So, this demand-based rate environment plays with, how much demand and how quickly people are going to consume a new home. And the lower we get with an interest rate, we go from a strong to a good to a limited to a weak. And we've been up in the weak market
For a long time.
And now we're coming back into the good. And I don't know, Cheryl, what are you seeing? Are you seeing?
I think it's trending that way. I can honestly say from my own perspective that we have more calls coming in.
Yeah.
And maybe it's not quite time, but the interest is there. And they're waiting to really jump in the next 4 to 6 weeks.
Which we love. We're seeing that ourselves where people are coming in. They're coming to us. We're a destination market in a lot of our market. We're starting to see people look again, which is fantastic. Now, I do love this slide, Cheryl, because just talk about this. It's my favorite slide.
So basically, we're comparing two loan amounts from April and now based on interest rates at 7.52 and 6.4. And what you see is a strong decline in the cost of that monthly P&I payment of $375.39. Now, some people would say, well, that's not much. But if you're on the borderline of qualifying, that is a lot of money towards your buying power.
Yeah.
That can elevate you. You can have a smaller down payment maybe,
right,
and still qualify for a home. Or if you're looking at the same down payment, you can purchase a more expensive home.
Yeah.
It really makes a big difference in what you can qualify for.
So I love this because, again, $375 a month, like you said, maybe it's not that much, but it could be.
It's a lot. For some people, $25 makes a difference in qualifying.
Wow.
It's really true.
Good to know. Always important to get that pre-qual so you know what you can qualify for so you don't go out and look for too low or too high homes.
Exactly.
So our friend Lawrence Yoon has a lot of things to say this month. So what's he saying now?
So he said, and this one I agree with, there is a large pent-up stored demand that could be released into the marketplace when conditions improve, lower mortgage rates, and more inventory. Inventory is finally turning up about 15%, and that likely is an early leading indicator that we may finally see more home sales as conditions improve. And I think that's huge.
Yeah.
We know there are people who've been waiting on the rates. That's the pent-up demand.
Right.
We know in COVID times we had a shortage of inventory, and people are sometimes afraid of the increase in inventory, but it's not so much that it's scary. It's good that we've got some more, so when the rates decrease, we've got something for them to look at.
For sure. I think inventory is good from that perspective. Absolutely. All right. So we've got Greg McBride from Bankrate. What's he saying?
He's kind of with me on it's not really plunging thing. The hopes for lower interest rates need the reality check that lower doesn't mean we're going back to 3% mortgage rates. Mortgage rates are 7% now, and the best we may be able to hope for over the next year is 5.5% to 6%. And that's within the realm of reason.
Right.
That is better than the historical average, which is 7%. And that's a good spot where, almost everybody can find an affordable price point.
I know we've talked about this before, Cheryl, but what was your interest rate on your first house?
13.5% with negative amortization. 10 years after we purchased the home, we owed more than we paid.
Oh, my goodness.
So that was the 80s.
Yeah. And so I had one of those first houses. I had a couple of houses in that time. I'd one at 10 and I thought I was living large, and one at 14. So, same thing.
I'll take 5.5 all day.
5.5 or 6.25,
Exactly.
6.4 as it was the other day, for sure. So what does Bill McBride say from Calculated Risk?
We now expect consecutive 25 basis points rate cuts in September, November, and December. The slowdown in job growth in the July report likely overstates the decline in the underlying trend. But if the August unemployment report is also weak, then a 50 basis point cut would become likely. That would be huge.
So what is basis points? Because maybe people don't know what that is.
So basis points are the percentage of rate cut. And remember, the Fed rate is not the mortgage rate,
right,
but it's an indicator.
Okay.
So if the Fed cuts their rate, it's an indicator that we will be able to cut ours.
Fantastic. I love that. So the good news is rates are coming down. I mean, and that's consistently what we're hearing across from all sorts of folks. So let's talk about home prices. Now, I love this, Cheryl, because really, a lot of people ask me about home prices every day. Are they going up? Have they come down? You'll see if you stay tuned through the end of this, or you can fast forward to it, what they've been for the last year over year in our markets. But tell us what Norada Real Estate Investments is saying.
They're saying expert forecasts lean towards a moderation in home price growth over the next 5 years. This translates to a slower and more sustainable pace of appreciation compared to the breakneck speed we witnessed in recent years rather than a free fall in prices.
Right. We were seeing things go up 15, 20%. And what the analysts are now saying for 24 across the nation, from the top 7 analysts, is 3.1%.
Which is a great rate.
That's great. I mean, for your home, instead of, first of all, you got to look at it because you're not paying a rent that's going out nowhere.
Right.
And you're gaining equity.
Exactly.
And tax deductions. I mean, there's a lot of good benefits.
There are a lot of reasons. And this is another one where when we're talking about the headlines, you'll see the headline that says the appreciation rate in home prices are falling. And people see home prices are falling. That's not what they're saying.
Right.
What they're saying is the appreciation rate is lower, but it's still at a good rate.
Absolutely.
Again, you got to look into the graph, look into the numbers.
I love that. And it even goes in 2025, and the same analysts are talking about a 2.7. So 3.1 for this year, 2.7.
Yep.
But every quarter we see them changing through the year. So stay tuned because they'll probably be different as we go into 25, and they'll and they've been actually going up.
And what is that based on? Demand.
Yes.
So the rates go down, demand goes up, we use up the inventory, that appreciation is going to increase.
She's got Economics 101 right there. So talk to us about what Lance Lambert is saying from Resi Club.
Well, Lance is saying even if the average national home price forecast for 2025 is correct, it's possible that some regional housing markets could still see mild home price declines, while some markets could still see elevated appreciation. That has been, after all, the case this year, frankly, every year,
right?
That's just the way it is.
That's the reality of housing. Good try if you think it's going to be the same across the nation.
Exactly.
It's just not.
It's just not.
It's just not. So our friend Odetta Cushy, I love her name, at First American, what is she saying?
She's saying while housing affordability is low for potential first-time home buyers, slowing price appreciation and lower mortgage rates could help. So the dream of home ownership isn't boarded up just yet.
No. And honestly, like you said, we're seeing $375 per month more buying power, which is a lot in a price of a home.
It is, especially for the first-time home buyer.
Especially for that first-time home buyer. All right. Equity and capital gains. We love this. So this is another slide that I love. So if you look at this slide, and it talks about the blue line is the owner's equity, which is kind of in the middle. The green one is a real estate value. And then the orange one is how much they have in liability. Oh my goodness. Look at that equity that's climbed through the years, Cheryl, on how much more. And that's in trillions. And that's adding them all up. That's incredible.
That's incredible. And that's what we're talking about when we're talking about building generational wealth, familial wealth through home ownerships, because you're building that equity and that trends towards whomever is going to take your home later.
That's a funny thing because we currently have a listing, and I'll bring this back to home, that the mother owned it, right? And she passed away. That's not a good thing, right? But she did pass away, and what she gave to her kids was at home.
Right.
And they're sitting on $1 million asset.
Right.
That's paid off, by the way.
Right. And she didn't pay $1 million for that property. So that equity growth is what will help the family into the future.
Yeah, which is wonderful. That generational wealth is amazing. So our friends at Realtor.com, what are they saying?
They're saying for decades, few homes appreciated enough in value between purchase and sale to exceed the $500,000 exemption cap. But a recent report from CoreLogic found that last year, 229,600 homes sold in the U.S., or 7.9% of all transactions, had gross capital gains above 500,000, potentially triggering tax liability. That's up from an annual share of 1.3% just 20 years ago.
So that's rather interesting. And if you look at this slide, this is the last column on the far right, shows that in 23, it was people gained more than 500,000 in their homes, 7.9% of them. Of course, in 22 was 8.1%.
Yep.
So COVID kind of pushed it up. But look at that in, what is that, Cheryl? My glasses are foggy.
The far left?
Yeah, far left.
2000 to 2003, it was just 1.3%.
Right. So amazing equity in these homes.
Yes.
And with that, potentially could come a taxable event. So I love what Danielle Hale said here to explain it.
Yeah, she says for most homeowners, capital gains exclusion, which allows you to pocket the first $250 or $500 if you're married in gains on the sale of your home without having to pay taxes on them, means that you're not likely to pay taxes on the proceeds from your home sale. But homeowners who have lived in their home for a long enough time or have seen substantial home gains should be aware of the potential tax impact.
We're going to have a slide here in a minute, but basically it's going to tell you to talk to your financial planner or your accountant. If you see that this for across the state, the people that have had 0 to 10% of gains, capital gains growth, in that 500,000 have been roughly the half of the country.
Right.
With a couple that are really outliers that are over 20%, and that's California and Massachusetts. So, kind of, again, if you fall into this category, get your equity, understand what it is, and then understand what you're going to do with it, and that, that liability you're going to have.
Right. If you're planning to sell, understand that you might fall into that.
Yeah.
And plan ahead as to what you're going to do with those funds and how you're going to utilize them to either eliminate tax liability or plan for how you're going to cover that.
Absolutely. So go ahead and say what NerdWallet has to say.
They're saying navigating the tax rules of selling a real estate or an investment property can be complex. Long or short-term capital gains tax will apply upon the sale, depending on how long you owned the house. But there are also ways to minimize or defer taxes on these types of properties. Consider speaking with a tax advisor or financial advisor to learn more. And that's absolutely the case, especially with investment properties.
Yes. Or if you're getting an inheritance of a property, or, you're downsizing,
right.
Or your spouse passes away. One of my clients, God forbid, her husband passed away, and we needed to sell it within a time so she could get the 500,000 instead of, $250.
Right.
So those timing things are really important. And if you're looking to talk to your realtor, make sure you're working with a knowledgeable realtor that can kind of lead you in that direction. And if you don't have one of these financial planner, tax accountant, whatever, they can help you find one.
Correct.
So this current market, I always like to talk about what's happened. So August year over year, if you look at this slide, we've got 2.5% increase from August of last year. So that's 2023 in Naples. In Marco, it's 2.6%. In the Cape, it was actually a negative number, but let's talk about what happened in the Cape. And Fort Myers is we had this little thing a year and a half ago called Ian.
Yep.
And they are still kind of digging out of all of that. So it's not unusual that their prices would have gone down. And Fort Myers got hit on the beach. We didn't look at Fort Myers Beach, which would probably be down, but we looked at all of Fort Myers. Right. So, we still saw growth in the last year. And people have been telling me the sky is falling, Cheryl. Property values are coming down. I don't understand, whether they're on the buyer or seller side, that news is terrifying them. So the thing I really want to leave you with this month is get an equity update. You'll see a link, a QR code, however you're consuming this data here. The goal is to understand what you have, how much you have invested, what is your equity in it, so that it's just like a stock. You start tracking your home, start going up that path so you know and can start planning for the future, whether it's giving it to your kids or, taking the money out and doing something different. Whatever that is, whether you sell now or in the future, you want to know your equity. So make sure, we'd love to give you one. not with us, go talk to your realtor. But certainly our team at the Bartos Group can help you do that. So until next time, I'm Mary Bartos with the Bartos Group of Premier Plus.
I'm Cheryl Stokes with New American Funding.
We look forward to seeing you next month.